2008. Yesterday, the House of Representatives passed legislation to approve a $700 billion bailout plan for Wall Street. This measure is unprecedented in United States history. Many people don't understand how this dire situation developed and how it relates to subprime mortgage lending practices. In this video, I will explain how the mortgage banking industry works and what led to the current economic crisis. I am a sociocultural anthropologist. I'm not an economist. However, I'm uniquely qualified to talk about this subject because prior to becoming an anthropologist full-time in 2003, I had an almost 20-year career in the national wholesale mortgage industry. Almost every type of job there is in that industry, I have done in one form or another. In this video, I will take you step by step through how the mortgage industry works and what changes over time led to the subprime meltdown and ultimately to the situation we find ourselves in today. My name is Heather Kyle. Welcome. What I want to do is introduce you to the players. How does the mortgage banking industry work? Who's involved? Let's start with the consumer. That's you and I, someone who is purchasing or refinancing a home. The next is a mortgage broker. That's who you go to when you decide you want to purchase a home. Their job is to take your loan application, to gather your documentation, to find you a loan that best suits your circumstances. They're your first line of defense. Next is lenders and banks. They provide an array of products, and by products I mean loans that meet a particular criteria or risk factor. They underwrite and approve your loans. They're the ones that check the documentation and the information gathered by the mortgage broker against your credit report, your job history, this kind of thing. They also provide quality control measures after the loan has closed. They go back and they make sure that all the documentation is correct, meets all the legal criteria, and that the information that you gave is correct. They may also sell these closed loans to investors, or they may retain them and service them themselves. And by servicing, I mean collect payment, send you the payment coupons, etc. They are the ones that provide the financing to the consumers. Next, we have investors and banks. Investors and banks, bigger banks, buy closed loans from lenders. They retain and service those loans themselves, or they pool them together to trade and sell as mortgage-backed securities on Wall Street. Finally, we have Wall Street. This is the flow, this is how it works. Next, I'll explain how each of these steps work and how they make their money. Okay. How do mortgage brokers make their money? Remember that mortgage brokers are who you as the consumer goes to get your loan. They take your loan application, etc., like we just talked about. Federal and state regulations dictate how much money a mortgage broker can make from a transaction. Brokers are generally paid on a commission basis in the form of something called points. Points are a percentage of the loan amount that can be paid by the borrower and are counted as part of the closing costs. They may be paid by the seller, but there are points that are paid to the mortgage broker. This percentage of the loan amount is usually capped around 1%. Usually the loan officers who work for the mortgage broker, because they are paid on a commission basis, pay, for instance, half a point to the mortgage broker's company and then half a point for their commission that is charged directly to the borrower. This is something that can be negotiated, and like I said, it is something that is dictated by state regulations. Additional points can be paid to the broker by lenders in exchange for selling you a higher interest rate. Say the prime rate is 6.5% and you qualify for a loan at that percent. What happens is, if they can convince you to take 6.625, for instance, the lender may pay them a point, or a quarter point, or 1 1/4 points, 1 1/8 points, whatever. As the interest rate goes up, so do the amount of points that are paid by the lender to the broker. This is also capped. This is disclosed on your settlement statement, and depending on your state, on your good faith estimate. A good faith estimate is something that a broker will give you when you apply for your loan that gives you a rough idea of exactly how much it's going to cost for you to get the loan you're looking for. And this will include your closing costs, your closing attorneys, your appraisals, your verifications, your credit reports, all the things that you need for the broker to present your case to the lender. Keep in mind that this translates into two things. This means that the broker is a salesperson. Keep this in mind because, as salespeople, unfortunately, have reputations for being somewhat shady. There are some out there. I'm not saying that all are, but the environment exists for you to be taken advantage of. What this means is higher loan amounts and higher interest rates translates into higher profits for mortgage brokers. Remember this later, we'll come back to it. Higher loan amounts, higher interest rates translates into higher profits for the mortgage broker. Next, we're going to be talking about lenders.